You do have to make changes, but not always.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
Welcome to Two Traders. It's Walter here. Hello, Darren.
Hello, Walter.
So we're going to talk about this idea of trading without a chart today. What do you think about that, Darren? What? I think that would tickle you. I think you'd be happy about that.
Yeah, definitely. I mean, can you trade without a chart and make profit? Of course you can. Yeah, you definitely can. I suppose there'd be elements of it that would be beneficial because we're certainly drawn to bad conclusions sometimes because of what we see on the charts and what we believe that represents. What I'm interested in is where the question came from. Is this, are you leading this somewhere, or is it a question that was posed to you?
Well, so what got me onto it was I was thinking about this week because I don't know how many of the listeners, or Darren, if you've read and I'll put it in the show notes for people, the Reminiscences of a Stock Operator book, which it's the old story about the guy who went in and made money from the old bucket shops which actually there's a lot of parallels to today. Like when you look at forex brokers, how they trade against you, most of them, nearly all of them, and how they, they make their money from assuming that their clients are going to lose overall. And so this guy would go in and he would look at the ticker, and he was basically like a tape reader. He would, kind of like the modern day scalpers who just look at the trades as they go through. So they're just kind of looking at on that the orders that are stacked up and that are flowing through the market. And based on that information, that's how they make their trading decisions. So they're not actually looking at charts. They're just looking at essentially trades as they go through. And I think that's basically what he did in the story. Now, the story is that this is a thinly veiled biography of. It said the book is supposedly written by Edwin Lefebvre, but it's actually Jesse Livermore, who was a pretty famous trader back 100 years ago, over 100 years ago now. And so that's what got me started on this, was this idea of, okay, well, if you weren't going to use a chart, what might you use? Well, there are actually traders out there who will argue with you that trading charts doesn't really tell you the most important information. You know what I mean?
Yeah.
Well, yeah. So the most important information to them is they don't care that over the last 1 minute, the euro had a high of 119.25 and a low of 119.22. Like, they don't care about that. That's not, that what they care about is how many orders came in at the bottom of that candle versus how many orders came in at the top. And what's happened recently, have more orders coming at the top or the bottom of the candle? These are the sorts of things that they're looking at because they're just looking at order flow. And bank traders do that too, really. They just look at order flow. So I just thought it was an interesting idea. Is it obviously there are traders out there that will tell you that, yeah, you don't need to look at the chart. You can just look at what's happening right now. How are the orders coming through? So basically they're looking at every single execution that pops up on their screen. And I suppose, I'm not an expert in it by any means, but I suppose they're just basically trying to figure out, is there a lot of pressure, on if you're thinking of that 1 minute candle, and it could be a 1 hour or, 1 day or whatever, but it's basically, but that would be a long time to sit there in front of the computer. They're basically trying to figure out, is there more pressure on the bottom of the candle or the top of the candle? Because they would argue that the close of the candle doesn't really tell you that. What tells you that is how many orders came in at the bottom of that candle and how many orders came in at the top, basically. They look the same to us as chart readers if we're looking at the chart, but to them, that's totally different information. I just thought it was a fascinating idea.
Yeah, I like the idea of looking at the problem from a different perspective. And we do seem to be kind of obsessed with this idea of looking at some price data over a period of time, maybe a single candle, you could say, or even a pattern of candles, and then using that as a kind of cause and effect of what's going to happen in the future. That seems to be what our obsession for retail traders. We seem obsessed with this idea that is the sole way to trade. And I like this idea of looking at the bigger picture and saying, okay, on a bigger scale, what generally happens in the movement of price, and not really kind of breaking it down into candles or candle patterns, but really how price moves and what is most likely to happen, what is least likely to happen, what sort of movements can we expect, and then looking ways of finding edges from that. I really like that idea, and it is kind of strange. Well, I suppose it's not strange that we're obsessed with this idea of reading the candle and developing a story from that. And I'm not saying that can't work, but in a field where everyone has a high level of expertise and learning and the same technologies, you do have to look for edges in different places, or it might be easier to find real edges if you look at the problem differently. And I really like that idea.
Yeah, exactly. Yeah. So if you were to trade just looking at the ticks or the orders that come through and make up the market, I suppose there would be a way to, somehow, and I'm sure of it, I'm sure there's a way where you can see that information. So it's not presented as a high, low, open, close sort of candle or bar chart, but it would be kind of shown as almost like a distribution, I suppose, as, how many orders have come through at 119.25 and how many orders have come through at 119.23, that sort of thing. So it's sort of like a distribution, and you would see whether the candle was heavier at the top or the bottom. And based on that, I guess you would be reading momentum. I'm just totally speculating here, but I'm just trying to think of how they would see that. So if you saw a lot of orders coming through at the bottom of that candle, you would suppose that the market was getting heavy and was going to go lower, and maybe you would sell. And maybe you would just, sell for a couple of pips or whatever, or maybe you would sell until you saw it start to turn around and go up or something, and see more orders at the top of the next candle or something like that. But I think it's interesting because no one really looks at it that way, or very few people that I know do. I do know that they do in the banks. Like that's pretty obvious that they do a lot of that, watching the flows of orders, and they kind of piggyback on that, or sort of go with the current, so to say, in their trading.
Yeah, definitely.
Yeah, so it's interesting.
Yeah, and I think a lot comes back down to where you believe the edges are in a market. Where can you find advantage? I mean, you could say that you don't necessarily need to see the roulette board to play roulette. You don't. You can just pick a number. You don't have to actually look at the dial. But the edge that exists or doesn't in roulette will remain the same, however you deal with that information. So, you might come up with a strategy where, you can look at where the ball's landed in the roulette over a sequence of spins and decide you have a strategy. But that doesn't change where the real edge lies in roulette, and that lies with the house. That is going to remain the same. So I think, with trading, the secret is to really understanding where the edges lie, and everyone will tell you a different story for that. Some people will tell you it's in reading price action. Some people will tell you it's in managing your position size. Some people will say it's managing your open trades, letting your winners run and cutting your losers short. Everyone will have a different belief on that, and who's to say what's right and wrong? For me, it's not in the entry. Or let me put it another way. The entry and where you decide to trade is one of the least important for me. But there'll be people who tell you the opposite to that. So I think what you believe is true about the market can change the way how you approach it.
Yeah, and there'll be traders that won't even look at order flow or technical charts and just say, well, I know that the Bank of Japan is going to be cutting rates, and I know that the Federal Reserve is going to be raising rates, and so I'm just going to base my trade based on that. So they're kind of like position traders. They don't even look at the chart. They put their trade in based on their analysis of the fundamentals, and that's it. And they just go with it. So yeah, I mean, that's another way of trading without a chart.
Yeah, and to me, that is the best way to trade. I think really you kind of need to me, the most important things to focus on are managing your position size and how you manage your winners. Okay, whether you have the ability to generate bigger winners than your losers, and then the rest really is fairly irrelevant to me. And then you kind of have to build a strategy to make that work. That's how I see the market. And then there's elements within that you have no control over, because you can base it on the fact that trends are going to occur, and then in this particular year you could have no trends, and you can't predict that, you can't control that. You have to leave that there is that element that you can't control in it.
Yeah, exactly. Yeah. I mean, it's the more I think about it, the more longer I've been trading, the more I think that one of the key things is learning how to be wrong. Like, when I think back when I first started trading, my biggest mistakes were when I couldn't admit that I was wrong. Yeah, I mean that's basically what you're saying. Is being able to and take advantage when you're right too. I suppose is the other side of that, right? Like making sure those losers are as tiny as possible, that they stop the bleeding when you can, and then take advantage of those opportunities when you're right. And it doesn't really matter how you do that, really. Like, I met a trader who he's always in the market, and he's always kind of just adding little positions here and there, and he just kind of haircutting them here and there, where they're just kind of, he's just kind of lightening up here and lightening up there, and he's always in a drawdown. And he's always got all these trades going, and it's just like, but they're all these little tiny trades, and he's just kind of managing the losers and capitalizing on the winners. And then the market turns, and then he's still got positions going both ways, and you know what I mean? It's just kind of this dance.
Yeah.
Yeah.
And I think also, it's not only about being wrong with your decisions. I think you have to kind of expect your expectations to be wrong as well, and that's quite a hard thing to take over a long period of time, because we really kind of want to nail down what's going to happen with our strategies, and it never really quite works out. It never really quite works out as you'd expect. There's always that element of variation going on, and stuff being distributed differently to how you expect, and you kind of have to deal with that as you go along, and you kind of have to roll with the punches.
Yeah. So you're talking more in terms of like distribution of winners, or are you talking about drawdowns or average gains per week or month, or what's a concrete example of what you mean?
Well, it's drawdowns is a good one.
Yeah.
I mean, how many times have you sort of worked on a strategy, tested it, worked out what your worst drawdown is going to be, your most consecutive losers, and then it just never really quite works out that way. It always kind of throws you a curveball, and no matter how much you prepare and study your strategy, your back test, and you go through all the different markets, it never really quite turns out like you'd expect it to in live trading, and that can be for various reasons, but you kind of have to have that open mind. Okay, this is kind of what I'm kind of expecting to happen, but you really need to be able to kind of adjust as you go along as well.
Yeah. So what's been the biggest lesson for you in terms of learning to for example with the drawdown? What's the biggest thing? Like, what's your go-to strategy or coping mechanism? You know what I mean? Like, so you expected a drawdown of 15%, and here you are sitting on a 21% drawdown or whatever. What do you do?
Yeah, I mean, I've been writing about it, actually. That's what I've been doing. I've been writing posts about the fact that you should kind of live with this belief that regardless of what you expect your drawdown to be, it's going to be bigger. And however many consecutive losers you think you should get, you're probably going to get more. So I'm kind of preparing myself for it. And it generally works out that way, but it kind of works the other way as well. I mean, you get more runs of winners than you ever thought you would. And, you get bigger winners than you thought you would as well. So, really for me, just kind of writing it and sharing with it and getting people's feedback and what they think on the subject has kind of helped me deal with it. I used to go down the path of, okay, well, there must be something wrong with the strategy, so I'll change the strategy. And usually it's a rush to change a strategy based on something that's happened most recently. And that rarely works out well for me.
Yeah, I agree. But it's tempting, isn't it, to just blame it and say, well, the market's not the same now, so I've got to change something, or I've got to change markets or something. Like, it's like a ready-made excuse just waiting for us.
Yeah, and I think it comes down to whether you believe, again, it's what you believe is capable, or do you kind of roll with the notion that, you're never really in control, no matter how much you've tested your system to prove that it has, a maximum drawdown of this, then, you can still blow up. I mean, how many real long-term traders have we seen say that they used this strategy for 15-20 years and it was always good and this was the max drawdown, and then it stopped working, and so they had to then go and change it. Am I contradicting myself now? You do have to make changes, but not always.
Yeah. I mean, like, the thing is, it's kind of like, the way I look at it, and maybe this is not the way that is the most efficient way to look at it, but the way I look at it is, let's say, like, for example, I've got a system that works really well in a trending market and it's just not working, right? It's like this week, it's just not working. So, you can step back and say, well, why is it not working? It could be the markets have stopped trending. It could be I'm just totally blowing it and I'm not doing the right thing. Like, I'm basically not trading the system because I'm being an idiot. I'm just doing the wrong things. I'm not managing or executing it as I should. Or is it something totally different? Like, I messed up the position sizing or something, which is, there are checks and balances for that. That's kind of inexcusable. There are tools and things that you can do to make sure that doesn't happen. But, that's the way I look at it, is like, what's the right tool for this market? So you got this range bound market where it's stuck between here and there. So, if I really want to trade this market, what's the right way to do that? That's the way I look at it, is, if I'm trading if I'm using a trend system and it's starting to fail, okay, maybe the trend's over. Or if I'm using a system that does really, really good with range-bound markets and it's starting to fail, well, maybe the market's starting to trend, and just take a step back and see if you're using the right tool. But I don't think that's the best way for everyone to do that, because I think if you have too many tools in your tool chest, sometimes it's just, like, I have a friend, for example. He has too many surfboards, okay, way too many surfboards. And so part of his day is spent, like, deciding, looking at the waves and going, well, I could take this board or I could take that board. It's like he's confused by choice. You know what I mean? And I think that the same thing could happen if you have a lot of trading systems. If you have too many trading systems, you can kind of get just confused by choice or take too much risk or something like that. So I don't know. I mean, to me, I guess it should be obvious. Like, when the thing that I strive for when I see a chart is I should know straight away, yes or no. When I see a chart, it's like, yes, there's a trade, or no, there isn't. Boom, throw it away, go to the next one. Like that. To me, it's like, it should hit me in the gut. And if it doesn't just jump out at me and sing, and then it's like, okay, next, So I don't know if that's the right.
Yeah. We get too complex into the notion of reading charts, don't we? I mean, it should be, you know, perhaps say a simple 4 or 5 things at the most that you look at. And I think we have this notion that if you go into more and more detail, that somehow the answer is going to be revealed. And I see some people's ways of determining if there's a trend or not, you know, and they go into so much detail that I think they're going down the path that they believe that is the answer. Whereas for me, the reality is, if you just made more of the times that you were right, it wouldn't really matter how you determine the trend. You know?
Yeah, exactly. Yeah.
And I know Dunn Capital trades that way. He trades a really simple, I think he's just got a really simple moving average crossover for determining when the trend's finished, and he just does that over and over again. But when he gets to one that goes on, he gets insanely massive winners, and that's how he trades. He doesn't go into a massive amount of detail of the price action and the level of this and whether it's diverging. He's just, okay, this could be a trend change, I'm going to take my trade. As simple as that.
Yeah, and they're always in the market, right? They're literally always in the market.
Yeah. And he has bad years, you know. He has bad years, but those bad years come when the trends don't occur. But when the trends do occur, he's in them. And that's, you know, another way of approaching the market, and he is looking at charts, but he isn't looking in too much detail.
Yeah. I bet most people, if they could see the trades like as they flash through, as the orders come through and they're hit, I bet most people could figure out where price is going to go. And I think, you know, it might take a week or something of just sitting there watching it, but I bet most people could do that. But I also think most people could probably just take one indicator, like a moving average or whatever, MACD or momentum or something, and figure out, you know, a simple trading system based on that too. I think we just complicate it too much. And think about this, like, what if you could take all of your winners and add 50% to those? Like, if you, like, so you let's say you have let's say right now you're listening to this and you're like a break-even trader. What if you could go back and magically erase all your winners and just add an extra 50% to that? What would that do for you? You know, obviously now you're in profit, right? Like, you haven't done anything. You've taken all the same trades that you took over the last month, let's say, but you just added an extra 50% to your winners. But that's actually not that hard to do. I mean, I know it sounds real simple, but you can just, when your trades start going in your direction, just add another position. You know, like, it's not that crazy. And obviously some of them are going to retrace and stop you out, and maybe you get stopped out at break even or a small loss or whatever. So those ones you're going to have some more losers than you would normally have. But if you could add 50% to, say, you know, half of your winners, I think most traders would take that. You know, that's a better result. It's a better bottom line. It might be harder to trade, but because you have to deal with those trades where it goes in your favor, and then you add to it, and then it comes back and it stops you out at break even or maybe a small loss. But for the ones where it keeps going, you know, those are the ones where that's where you make all of your winnings for the month.
Yeah, definitely. Talking more about this, you know, the notion of looking at charts and not looking at charts. You know, do you think it's how appealing they are visually to us, and that leads us to be, you know, so in love with this idea of reading charts? Is it because we like patterns and we like to be able to develop a story around things? You know, is that the main reason, or is the real benefit in reading charts? Well,
I think you're right. I think like, I look up into the stars, Darren, and I don't know about you, but I can't see all those. Like, I can't see the horse and the crab and the, you know, all those things. I just can't see them. But obviously, people have looked long enough and stared for enough years that they can see those things. And you know, we have to admit that our trading platforms, like, if you sat down next to your trading platform and you like, let's say you take somebody who's never seen a trading platform, okay, and you sat them down in front of your trading platform, and it doesn't matter what it is, any forex trading platform, and then you take that same person to Las Vegas and sit them in front of a video poker machine. I don't know if they'd really be able to tell much of a difference. It's the same thing, isn't it? It's just flashing lights and sounds, and it's all made to look rather exciting and keep you, keep you putting your quarters in or whatever, your dollars or whatever. Yeah. I mean, that's really what it is. And so I think brokers understand that we're very visual, and I think that it just makes sense. So many people are so visual, it makes sense for them to look for visual clues and cues. And I think it's easier for us to come up with visual stories. So yeah, I think, but I don't think that that's necessarily bad. You can embrace that and go with it. It doesn't mean you have to fight it, but yeah, I think you're right. I would have to agree with that. Yeah.
Yeah. I think it's important to understand their importance in the big picture as well.
What do you mean? Like how so?
Well, let's say you like trading pin bars, okay? So they stand out and are fairly obvious, and price moving down and then reversing and going up in itself can be a good indication to trade long, okay? But just trading pin bars is just say, right, okay, well, I'm just going to trade every pin bar is not going to be the answer to being profitable. It's going to be how you manage the stops, how you manage your position size, and how you take profit on them. And then the bit you have no control over, what the market actually does. Okay, so I mean, if you have only bullish pin bars occur in a strong uptrending market that's trended for a long time, then you're going to do well. Okay, but then whether you do really well is about how you manage those winners, whether you took profit quickly, whether you trailed a stop, those sort of elements. And the actual pin bar itself really is probably the part of least importance. And a good way to highlight that is find a successful pin bar on the daily time frame, and then have a look on the 4-hour time frame and see what that pattern is compared to the daily. And you'll find that the pattern that happened on the 4-hour wasn't, it's not necessarily always a pin bar, but it represented the same movement in price. Price went down and then it went up. Do you see what I mean? If you break down the actual data to smaller time frames, you can realize that really all that happened is price went down and up, and the actual bar is not significant.
Yeah, exactly. Yeah.
I know you use patterns like that, but I'm arguing that the reason they're successful is not the actual pattern, it's how you manage those trades afterwards.
Yeah, I've looked at the data. Like if you just took every single one, you would be in trouble. So like, for example, like it's kind of like saying take every inside bar, right? Or every inside. Well, not every inside bar is the same. Like if the previous candle had a, let's say that the candles on your daily chart that you look at, they're typically around 80 pip range on the day. Well, if you had an inside candle that was 100 pips because the previous candle, the outside candle was, 350 pips. Well, technically you've got an inside candle there, but it's not, you know what I mean? Like it's not really relatable to the one that's a 30 pip candle that's inside of a 75 pip candle. You know what I mean? So like they're not all the same. Yeah.
Context.
Yeah. Context is everything. And for sure, managing your, trades, like how do you get out of your losers? How do you get out of your winners? All that's, what matters. Yeah. And so it's funny though, like, when we first start trading, I think most traders, we want a magic solution that's going to give us a lot of winners. And we don't really pay attention to the, to the numbers, to the expectancy, to the reward to risk. We don't, like, that's not as important. That comes later. That comes later where we focus in on that. At least that's what I've noticed for most traders. And certainly for me, when I first started trading, it was all about finding winning trades. And then it became, okay, how do I maximize my winners and maybe give back some of those winners and let those be break even or losing results in exchange for much bigger winners. And then from there, it's like, well, so how do I really compound this when I'm right, And then finally, like, how do I stick to this? That's the psychology, right? I think this is going to work, but how do I stop myself from sabotaging myself and telling myself that it doesn't work anymore? Yeah. Okay. So, all right. So this idea of trading without a chart sounds like there are many different ways to trade without a chart. It looks like, I think people do. I don't think when Warren Buffett back in 2000, I think it was 2006 or 2005, he sent a whole bunch of US dollars into Aussie dollars. So it was like an unleveraged trade. I don't think he was looking at any chart. All I think he was doing was basically just assuming that, the Australian dollar was going to go up. And he was right, and that the interest rate differential between Australia and the US would be so great that the Aussie dollar would go up quite a bit. And so he didn't have any, he wasn't looking at Bollinger Bands or anything like that. He was just, he had an idea and he just acted on it. And so that's one way to do it. You can just have a simple idea and you can act on it. You can look at order flows. There's lots of ways to trade without charts. So I think even though most of us are drawn to charts, certainly it's not the only way to trade.
Yeah, totally agree. And just understand how your eyes work and how they interact with your brain, and study that a little bit. Understand how we work as human beings, and then you can spot pretty quickly where some of the flaws are in your approach to trading, especially with the visual aspect of it.
Cool. All right, Darren, thanks for your time, and we'll see you next time.
Okay, cheers, Walter.